My strategy in the early days, or my why, was to have some consistent income, right? I was in a sales role. I had a growing family, and sales, just like the economy, has ups and downs because of business cycles. And what I did know, what I learned was that having some rental income would provide some stability for my family.
Jeff, welcome to the show today.
Thank you so much. What an honor.
So you're not only a syndicator, you own nearly 1,000 units yourself, but you're actually a logistical supply chain expert. Tell us a little bit about your professional background, and then we'll get into kind of your syndication background.
Absolutely. I'm born and raised in New Orleans. So I was married in June of '05. Hurricane Katrina hit in October of that year. And so from there, we moved into Houston, Texas, and I just went door to door looking for a job. And that's how I got into the logistics business. I got into a desk level, just data entry job. And I learned the business from the ground up to now. I really liked working with customers and figuring out problems and solving problems. And now that's what I do. Just on a little bit bigger scale, I help customers all over the world solve those problems.
And I'm sure you've got your hands full. Now, why did you get started with real estate, and what did that look like in the early days? What was your strategy?
My strategy in the early days, or my why, was to have some consistent income, right? I was in a sales role. I had a growing family, and sales, just like the economy, has ups and downs because of business cycles. And what I did know, what I learned was that having some rental income would provide some stability for my family. And what that looked like was when I moved, we saved up enough money to have a down payment and keep our house that we purchased, and we turned that into a rental, and I really like that. So then I bought another rental and another one. I got into wholesaling and flipping, and I just got into a whole lot of single family activities as a side hustle, I guess.
Yeah, that's always how it starts. And at one point, did you pivot?
Mhm.
Why did you pivot into multifamily?
Because it was an ever growing side hustle and I could not scale. And so last year obviously was just a banner year for real estate, and everything that we touched seemed to have the Midas touch, right? And I was just coming home at 1 o'clock in the morning after dealing with subcontractors and managing all that. And after every single project, I was starting from ground zero. But I was watching, one of my lenders is a syndicator. And I called him up one day and said, I'm doing something different, obviously. This is good, but you guys just keep building on your portfolio and it keeps getting better. And so we went and we had lunch after I handed him his hard money loan back after closing a deal. And he said, this is why, this is the difference. And so from there, I hung up the hat on single family and put it all into multifamily.
That's interesting, and it's very common that many people get started in single family house investing because that's what everybody talks about in the books and the meetups and and TV as well. It's cool that you're able to pivot like that, and most people will then pivot because for the same reason you just said, you can't scale, and it seems like
Mhm.
you kind of created a rat race a little bit. So how did you get into then the syndication world? Like, what were your steps, and how did you finally get in? You're like, oh, I got to change, but then what did you actually do to get into that?
Education, right? You surround yourself with like-minded individuals, and I got into a group with the education to learn what this is, how to underwrite deals, how to source deals, how to fund deals. And we together have, it's been a great community. And so I just followed the lead of my hard money lender at that time, who was a good friend, and I joined the same community as they were in.
It's so important, is education and community, right? Those are really
Absolutely.
the two things that will get you in. And also, when you do that, I found that your entire perspective changes when you get into a whatever community is, and you see these people and the things they've accomplished, and they don't seem much different than you. If this guy can do it, this gal can do it, I can probably do it, and it just gives you a lot of confidence. And so,
Mindset.
yeah, mindset. That's a big thing. And then so you
Yeah.
you started doing deals, you started raising money. Talk a little bit about that.
Yep. So I was very quick to invest as a limited partner, and I'm still investing. I have a self-directed IRA that I will invest as a limited partner on multifamily deals. But I began to see and all the activity in this community. It's inspiring. It is truly inspiring, and it just makes you want to do more. And so I knew that with my sales background and my interaction with people in all sorts of business, that maybe raising capital and syndicating deals was a good avenue for myself to get into multifamily.
I want to know, because you have this unique perspective, is that we all know in the syndication business or construction business, we've had major issues. In fact, arguably, you could argue that the problem with COVID wasn't rents or even eviction moratorium or anything like that. It was really related around an inability to turn units on time and on budget. And it was really related to inflation and price run up. It was related to not getting certain supplies. It was related to people not showing up for work. And you have a very unique behind the scenes look at maybe what's been happening behind the scenes. Can you try to explain kind of what happened since COVID and why we're seeing what we're seeing right now?
Perfect. You started with the end. But yeah, you're absolutely right. And I will start from the beginning. That's where I operate, is in that global logistics. And so what happened was COVID, right? The US announces a 14-day shutdown. And what that meant was the US consumer could no longer spend dollars on what they're normally spending dollars on. What do we normally spend dollars on? Travel, right? Restaurants, concerts, all of these things that we're normally spending dollars on. Well, they now got consolidated, and we could only spend dollars on consumer goods such as Amazon and Lowe's and Walmart. And so this drove that demand to sky high levels. And I would venture to say that 90% of those products are made overseas in China and Southeast Asia, which are moved primarily by boat. And so all of the product on the shelves throughout the distribution channels were quickly depleted, and the demand for those products shot up, and the ocean vessels did not stop moving. But what did stop was the labor at the ports.
Hmm.
So there was a slowdown there, and this created this massive backlog at all of the ports.
And why would the labor stop? Was it due to literally the health related aspects of COVID?
Well, there was a shutdown, right? So everybody had to stay home. And so while they did not stop, the shift work became safety focused, right? Safety of the employee first. So they had these odd shifts and only so many people in a certain area at a time. So while you could unload a vessel in 90 to 120 minutes, this began to be a 2 to 3 day time period. And so the vessel turns really slowed down at every port. This just went on from March to mid of last year. And then what happens when a demand for a product really, really increases? Well, that product price skyrockets. And then my business is the transportation of that product. And I will use real life scenarios of money. For my entire career, almost 2 decades now, the price for a container from Shanghai to Houston, Texas has been around $3,000 to $4,500 any given season. The containers that we're talking about have gone up to $28,000.
Wow.
So put yourself in the shoes of a business owner who has an annual budget of $500,000 just as a bottom line item, right? Before net or operating income, $500,000 for transportation. Well, that is now anywhere from 2.5 to $6 million. And the challenge with that is that the retail price, their goods hadn't adjusted to reflect recouping that money yet. Not until Q2 of this year.
Before
And
you
that
before you go there, the one thing I don't quite understand, I understand the demand outstripped supply, and it was
Mhm.
exasperated by COVID. But what I don't understand, 9 months, 12 months, once we were back from lockup, why were not people not going back to work? Why didn't that, in other words, why didn't it normalize to what it was before? Is it because the supply was so sky high? Is it a combination of people not going back to work, or why did that not go back to what was more normal?
You have to be a little bit more specific about industry, right? Because I know that where we're at here in Houston, I think that the restaurant industry is still having trouble. And um, aside from that, it has to do with pay, you know. So from a labor perspective, it's more aligned with pay.
Let's do logistics, like the example you just talked about, right? So the container went
Yeah,
from
yeah.
4,000 to 28,000. Why in the world is it still this high? Why didn't it go back to $4,000 when everybody came back? And theoretically, things normalized, but they didn't.
Let's go back to Q2 of this year. Those containers were still moving at that level. Companies are still paying this amount of freight. And the reason is they want that product on the shelves to sell to the consumer. When did inflation become a news item? Inflation became a news item around May, June. Meanwhile, that's when demand stopped. And I will tell you that May container prices were this high. June, they dropped 50%. So I was beginning to make predictions that we would be at pre-COVID levels by November. As of today, we're below $6,000.
Mhm.
So you made a fantastic point is why haven't they? Takes a little bit of time, but those prices are catering right now. And it's peak season. This is normally a time where prices are rising because these retailers have to get prices, their inventory on the shelves for what? Black Friday. Product's already there.
So why does it feel like, at least on the construction side, that there's hasn't really been like a reset on that side? I don't know if it's labor. It seems like materials should be coming back down, but it
Yeah,
I haven't seen any relief yet,
no.
at least on the increase around any kind of construction project. And so why is that?
Because you're going to look at about a 6 to 12 month lag before these prices hit the go all the way through the distribution channels, right? So just all the way through last year, while these transportation costs were being burdened on the business owner and the businesses and not passed through, now all of that inventory is absorbing those costs, those increased labor costs overseas, the increased transportation costs, the delays. That's what's sitting here in the distribution channels. Well, now as the prices come down, we're going to have another 6 to 12 month lag before it flushes out and flushes through. So you should start to see that in about 6 to 12 months.
So you're thinking that on the supply chain, at least, it will go back to pre-COVID levels? Is that what you're predicting?
On logistics, we're seeing that trend down in the next month or two.
So then your only cost is going to be, I mean, that's still going to probably stay up on the construction side. So you got materials and you got labor. Labor is probably not going to decrease. It might, but there's still the inflation demands on people to, they have to spend more for things. So in general, and people are used to making more on the labor side. Potentially, we've had issues on both the labor and the material side.
Yeah.
But I'm just curious, what's your take on that side of it?
My take is you look at the double whammy effect of what's happening between the market dynamics of supply chain and it just working itself out, right? The kinks working itself out. And then the Fed going so aggressive, rising the interest rates. They are not shy about it, telling everybody they're going to do it again before the end of the year. And so we're really, the Fed is, Jerome Powell's really attacking the interest to slow down that. And he was very outspoken about the fact that while people are enjoying these higher wages, there's going to be layoffs to be felt. And I think that will deal with that wage issue that you're speaking about.
So higher interest rates. I mean, obviously it affects real estate, affects your mortgage, your debt service, things of that nature. But how do you think these higher interest rates are going to affect the supply chain that we're talking about here? Is it going to go back to some? Is that going to create issues, or are you still going to normalize itself out?
Capacity eases congestion, right? The problem, one of the big problems with this supply chain issue was the amount of congestion at your major ports, such as Long Beach and New York. And right now, and Charleston and Savannah are experiencing some congestion. So as demand decreases, then the congestion is going to open up. And so these supply chain issues will, again, that's going to facilitate the ease of some of these burdens.
And this is kind of what the Fed wants to do. Their idea is that they're going to drive up interest rates to lower demand. That's kind of the idea, right? People can't get as much cheap money anymore, therefore they can't buy more stuff, and therefore that will ease supply chain issues at the ports because people are going to buy less stuff.
Right. That's the goal, is slowing up all this cheap money that's been going around, and um, put the brakes on this economy or put the brakes on the inflation. I don't believe it's their intention to hurt the economy. It's their intention to stop inflation, which is getting really out of control.
Yeah, but they probably, we've seen them mention, or like, if it goes to a recession, well, oops, like that, like we've seen Powell say
Yeah.
something similar to that, right?
He did say that. He said it's very likely, but
Yeah.
it's a dose of harsh medicine.
In that specific thinking about that, some people are going to be really scared, and there's also, you know, a ton of opportunity in that side as well. You know, depending on where you're kind of sitting going into that situation in general. But yeah, I think that at least on the construction side, hopefully, you know, that reset happens to a degree where it makes more sense. There's also one thing that's happening on the new builds. So a lot of new construction is halted in general, and what you're seeing is these contractors are out of work, so there'll be more jobs available and lower wages, even on that side with the status of these new construction, new builds that exist currently. I'm curious, what is your year outlook on the market in general? Where do you think we're headed?
I think we're headed is a few downticks, and 2 years out, another uptick. In terms of real estate, I'm still waiting to see the cap rates rise, at least here in the Houston market. Sellers are still holding on to that 2021 sales price. Uh, they're a little bit unreasonable, but I do believe there's a correction coming. I don't think it's 2009 levels. I think banks were a little bit wiser than they were previously. So it's just I think it's a slowdown. It's not going to be as bullish.
How do you even underwrite a deal right now?
I was going to ask the same exact question.
Quite honestly, I'm looking at, are the fundamentals solid? Bridge debt is at 7.5%. So that's tough. And we're looking at the occupancy. Is it strong? What are the income levels, the median income in the area that we're writing? Because we believe that specific areas are going to get hit harder in the recession than others. So what is the risk profile of the property and where it's at?
Specifically on that, I mean, I'm just curious, like, are you looking at deals more so with agency loans, potentially with fixed rate debt, over bridge loans? Because I mean, you could do it either way. And then what are you kind of forecasting as even an exit cap on these deals? Because that's really tough to manage everything. Obviously, the, you know, cap rates in general are up, but maybe not up enough. I'm just curious, anything that specifically you're looking at on that side?
Think about 3 that we wrote offers on over the past 2 weeks. There was 2 of them were loan assumptions. So that's very attractive.
Smart, yes.
And I'm gonna be honest, I think they're coming out a lot more, where the creative financing is becoming more and more attractive. 2 we made offers on, they got rejected. I mean, they're still wanting the same price that they wanted quite literally a year ago in September of 21. And this last proposal we sent out this morning was for a loan assumption or new debt. And believe it or not, the new debt would be better because the equity raise was less. But you hit the nail on the head. We prefer agency debt. Agency debt would be nice because it's fixed. My only concern there is the prepayment penalty if we wanted to leave earlier, right? In 3-4 years, market swings, and you know that could have an effect.
You're really seeing 2 scenarios that are playing out right now. Well, really 3. So one is the assumption, like Jeff mentioned there. Then you've got basically a 50% down payment on an agency loan of some sort. It could be variable or fixed.
It
Maybe
was-
it's literally 50%. Sometimes there's a prep equity piece you can throw in there, but it depends if you have those kind of relationships or not, to help offset that 50%. But you're seeing a lot of 50%ers right now, which is crazy. And then you're also seeing the other side of that is bridge debt, but people are shying away from bridge debt more often than not because it's so expensive, and it's putting people in a position where they're maybe a little bit more at risk with, and they have to deal with the interest rate caps, which are just completely blown out right now and the cost
Correct.
crazy amount. So it's just overall, it's more expensive to go in and do a bridge deal. Where I'm seeing people compete on deals right now, they're really, a lot of people are competing going in with the agency, and sellers still haven't really come off their prices that much. Like you said, they haven't really realized, hey, this is over necessarily in bulk. So we'll see how that shifts into next year, but it's always good to hear a perspective as to what other people are seeing out there, as far as how they're underwriting deals and how they're approaching it. Are
Yeah,
you even looking out? Go ahead.
I was going to say, we don't pursue heavy lift value add. I don't have the infrastructure to do that. I'm curious how those projects are being underwritten right now.
The value add. So you guys don't do value
Heavy
add?
lift,
Oh,
heavy lift
on it?
value add. I've seen
I
some
don't
of
even know.
those, and
Are you talking about like super vacant deals?
super vacant,
Yeah.
just run down. I mean, it's going to have a 60%
No,
equity
like
rate.
if you're selling a deal right now, your deal has to be pretty much over 90% occupancy so that it
Right.
qualifies for agency, or else you're not really getting a deal done. And also you're not seeing deals happen as often in the worst areas of the market because it's just not as
Right.
favorable in general. There's too many headwinds on that side. And so I think that, a lot of the stuff you're seeing, it's like better areas, better product in better locations, with higher occupancy. Those are the things that are trading right now because just overall sales volume is down a ton.
Yeah.
With where we're sitting right now. And it's not going to be normalized until the rates stop going up. I mean, it's crazy. I would say right now it's probably worse than when COVID started. And depending on when this episode airs, obviously, but for right now, it's to transact. It's just brutal in that form.
There's several deals that just get blown up specifically because of the debt. That you would think it'd be a fairly just a fair deal, but when you plug in the debt, it is not, and it does not work.
Jeff, man, so great to talk to you. Thanks so much for coming on the show. How can people get a hold of you if they want to reach out?
We have a white paper on why we like multifamily, and it's multifamilyadvice.com. Just go to multifamilyadvice.com, put in your email, download that white paper, and you'll have all the information you need on getting in touch with me. I'll shoot you a quick email. I would love to talk to you, even about single family one, but we're wholly invested in commercial real estate and the multifamily space as a whole here in Texas.
Awesome, Jeff. Thanks so much for coming on the show.
Thank you so much.